And welcome everybody to another session with me, Mike Smith, CEO Trader IQ. Today we are looking at why entries seem sexier than exits. Let's get real, guys. A massive amount of airplay and effort is given to trade entries when comparing to trade exits. So much so, I've invented a new trading term. It's called entry arousal bias. And we're going to discuss that in some detail and the 6 influential factors on why this exists. It is normal, so it's okay. If you have this, it doesn't mean you're strange or unusual. It just means that you're a normal trader and you need to do some work in terms of balancing. Because unless you start to make some headway on this, those 6 influences on the capital eroding entry obsession isn't really sexy at all. My job here today is to guide you through those 6 influences so you can make a judgment on where you are now and potentially put some things in place. So let's get into this. We're calling it rebalancing trade entry and exit focus to optimize profits. And let's talk a bit more about this entry arousal bias that I've just invented. And ask the question, have you got this trading bug? Is this disease going to influence your trading outcomes? The reality is that most traders will suffer from this to some degree, and it's not your fault. That's the good news. But it is your fault if you choose to do nothing about it. Now you know about it, or at least you will by the end of this session. And what it is, it's the excitement of finding that perfect entry point takes over from having a healthy balance of focus and attention on trading exits as well as entry. Now, just as we start here, I'm not suggesting for one moment that a good trade entry is not important. It is. What we're talking about really in this session is the rebalancing of effort in learning, in discipline and energy into exits and how vital this is if you want to become the trader you can be. So let's look at these 6 influences on entry arousal. Remember, it is all about rebalancing. There are positive aspects to these, which shouldn't be overlooked. But equally, there are things which you need to work on. The good news is what you've done to date is not important, apart from having honest awareness of what you have done to date and what you're doing now. What's really important is what you do next. So as we work through these 6, see if any resonate with you, and see if the suggestions that I make on some of the things you can start to look at, start to mind shift with, may be of use to you. Number 1 is the potential for profit. This concept of hope springs eternal when we looking at entering trades. Entry points are often associated with the potential for profit and growth. We see the potential there. We can see on a chart how far it might go. They represent the beginning of a potential opportunity, but just to stress, it is a potential opportunity, of course. It only becomes a reality should the trade move in our direction, and then we effectively exit. We often get caught up in our own success stories. We'll take credit for those trades which go very well and place blame somewhere else when they don't. But we'll be very proud of those entry points where we caught a significant trend or breakout. And often, and I can say this from experience, every conference that I've talked at, many of the webinars that I run on live sessions, one of the most common things that I'll hear people ask is, well, what did you use to get in? What indicators are on that chart? Not what exits did you use to create those great results that you've demonstrated, Mike. And as I said, it's easy to place blame, whether justified or not, as to why a trade didn't go your way once you're in it. It's sort of comforting that when you enter a trade, it's not very often that you can easily see errors that you've made already, or at least those that you're prepared to admit to. So this expectancy, this hope that this is a start of something great in this particular trade is one of those influencing factors. And although it's right, you feel that way to some degree. Experienced traders, and there are many listening to this, I'm sure, understand a well-planned exit strategy can preserve capital and lock in profits, making it equally as vital as high probability entries. We less often highlight the essential exit strategies that allowed us as traders to capitalize on whatever entry point we choose. And perhaps we should readdress that. Number 2 is complexity in learning. To enter is easy, to exit is not. Initially, entry strategies may seem quite straightforward, focusing on trends, patterns, breaking news, and price action overall. It's something that appears to make sense. But why does it make sense? Well, it makes sense to the degree that often if we have results that are not favorable overall, what we do is we double our efforts to add to more entry criteria, put another 14 indicators on a chart, make it look even prettier with even more colors, or throw out a system completely and start again. We're much more likely to do that than we are to explore how we can improve our overall outcomes through simply improving our exits. Again, this is normal behavior. I want you to look in the mirror and ask yourself, is this what I'm doing? Now, the reality is that the principles of exit aren't that complex. They aren't that difficult. But if our learning focus has been entry, then Even the basic intricacies of exit are less familiar, and so seem harder. As it is with any learning, if you're starting with a good grounding, with a fair amount of knowledge already, it isn't that hard to add something else. Whereas if you haven't done any learning or any work or invested any energy in something at all, it's going to appear that much bigger, that much harder to master. So it's just a rebalancing thing again. On the surface, exit strategies may seem more complex, require deeper understanding, but the reality is not that at all. Yes, they're equally crucial in a comprehensive trading plan, we can't deny that. But if you neglect exit learning in favor of yet another entry strategy, your results are likely to remain the way they are right now. Think about this for a moment. How many strategies can you think of that you could put together for entries? How many indicators could you use? How many different ways of exploiting price action could produce a good entry strategy? Double figures? More than that? And yet, with exit, there's only three things you can do. You protect capital risk through having some sort of stop. You protect profit risk by having some sort of trail. And you have points at which you take profit. Those are the only three exits you can master. And you can plug them into any entry strategy. All you're doing is making fine refinements. But once you've mastered those three, then that's all there is to master with exits, apart from obviously the psychology of making it happen. So is it really that difficult? If it's not really that difficult, then isn't it time you invested the energy and effort to make sure those systems you use for exit are top drawer? Influence number 3 is marketing and media. Both the media and education companies and how they market now to push your excitement buttons. They know that traders have this entry arousal bias, and they will exploit it, either for viewers or for money. It's the harsh reality of things. Give the punters what they want. So the financial media and marketing often focus on hot trades, trading tips, entry points, adding to any bias that may exist already towards the excitement of buying and the myth that this is the gateway to profit. This extends beyond the technical, as fundamental entries are often discussed. This stock is at value. This stock's overvalued. This stock's undervalued. This undervalued stock could be one to get into now. But exits are rarely talked about, taught, or demonstrated with fundamental entries either, neither at the time of recommendation nor later. And of course, then we have our education companies. Some are excellent, some would highly recommend. But the reality is that many of them use marketing strategies based on pushing your excitement buttons. They'll come up with snappy entry strategy titles: the breakfast breakout, the 6 o'clock shuffle, the rampant yachtsman, or whatever they choose to try and grab you, play into that entry arousal bias that may be in existence to some degree. You never hear them getting as excited or coming up with the same snappy marketing titles to do with exit. Here's the thing. For my client base, I did a project a couple of months ago called Exit Rule OK. And what they did was they chose trades for me at random for the next 20 days. And irrespective of what was happening on the price chart, I had to enter them and then publish them in front of them. So they're all verifiable results, all audited. And there was a 75% win rate, no entry criteria at all, apart from they had to be tradable on an MT5 platform. So include share CFDs, Bitcoin, indices, FX, right across the range. And they chose them all prospectively. So there's no bias involved and still made profit. Now, the reason for doing that slightly bizarre project was to show the importance of exits. Now, could I have done better if I'd had high probability entries? Well, yes, I could, because there was only one of those 20 trades which actually looked like an entry when it was actually entered. Now, this is not me trying to impress you. This is me trying to impress on you the importance of exits and why it is important to get that rebalance right. So in your thinking and in your learning and in your effort and energy that you're putting into trading, a more balanced way of approaching this is to invest at least equal time, if not more so, in mastering exit strategies, even though it might not be sensational, even though it's not attractive in the same way that entries are. And of course, by all means, if you find somebody that you're listening to is presenting great charts of the day or great hot tips, then of course follow them. Why wouldn't you? But make sure that you have an exit strategy plan for each. Just again, that rebalancing is what it's all about. The fourth influence is emotional appeal. It's you against the market. Many traders love the challenge. I do. It's one of the really compelling factors when I kicked off a couple of decades ago. The act of entering a trade can trigger a rush of adrenaline and optimism, making it very, very emotionally appealing. At the time of entry, This optimism translates into a situation where at the point of entry, you're not wrong. And you have the comfort psychologically of knowing this is the case. It's only after entry, of course, that you start to feel, oh, maybe this wasn't the right thing to be in. And the problem is this concept of wrong. If a trade doesn't go your way, it's not that you've been wrong. It's just that a trade's gone against you. That's what happens. Markets are uncertain. You're trading risk. It's a risk that creates the potential profit, but also creates the potential loss. So you need to move away from a dollar focus on each individual trade, which is termed an outcome bias, and move towards your processes in putting together systems which include high probability entries and, if you like, high probability exits. There's another term that we've just invented. Exit strategies, although they're probably seen as less thrilling, provide control and contributing to develop reliability and ongoing success. Your purpose for trading is to develop a system or set of systems that are reliable. Once you have done this and have the evidence through performance measurement of every part of your system and, of course, performance measurement of you as a trader in your interaction with the market, then all it remains to do is scaling. Now, I know the psychological impacts of scaling, which you need to manage as well. But it all goes back to that purpose being developing reliability. And that's irrespective of market conditions and irrespective of whether single trades win or lose. The psychology of dealing with a trade that went against you is harder to take and is therefore potentially less exciting, less appealing to focus energy and effort on. Unless you accept and feel comfort at seeing losses as part of your success process. It's a really important point. I don't want you to be happy when a trade goes against you. But I want you to see it as part of your success journey, providing, of course, you stick to what you said you were going to do in the first place. I hope that makes some sort of sense. Number 5 is a proactive bias based on the concept of you've got to get in it to win it. And of course you do. The act of entering a trade is seen as taking action, making a move, which inherently seems more proactive and attractive. The challenge and adventure associated with entering and so potentially beginning a profit journey in a single trade rarely produces the same anxiety related to what can happen next after you're in it. It all feels good. It feels exciting. It feels challenging. You've got that hope. You've got that expectancy. No anxiety. It feels great. And so therefore, if it feels great and it looks great and it is great, why wouldn't you invest energy and effort on it? Well, the reason why you wouldn't invest too much energy and effort from it and ignore the rest is because that's not what is going to make you a successful trader. The reality is that exiting a trade is an equally decisive action. You need to build up your internal narrative relating to this, regarding the need for unambiguity, pre-planning, and the necessity of good exits to contribute to that trading purpose and the objectives you have for trading in the first place. Change your challenge to one of reliability. Recognize that exit is not a passive process. It's an active, pre-planned action that's absolutely critical. And recognize over time, though it's harder when you're a newer trader, that seeing losses and accepting that they are, and even treating them as a success in terms of part of that journey on your trading for a lifetime. That mind shift allows you to reduce the anxiety. Now, as I said, it is more difficult at the start as an inexperienced trader, but over time, providing you continue to do the right things, providing you rebalance that effort accordingly, providing you measure performance so you can see what's working and what isn't working, then it puts you in a great place to be able to reduce your anxiety after you're in a trade, which is going to help you do the right things. Finally, is the trading tools. Now, it's not tools for half a job, really. It's you're only using the tools that you have half of the time. And what I mean by that is many trading platforms provide tools, visual aids, indicators for identifying entry points. That's certainly the way that they are described in the literature. You look around the internet and you'll see MACDs and parabolic SARs and whatever else you want to stick on a chart, and it's invariably described in terms of entry. However, take a step back, think about this for a moment. If we look at the ways the market moves and why we would enter back to price action, the reality is that when something is in uptrend, for a potential entry, we're looking for a reversal. If something is a sideways trend, we're looking for a breakout up above or down below. So we're looking at these price actions and trying to use indicators which are giving us some clues that mean it's more likely to move for some prolonged period of time. And so these indicators which give us these clues, which give us reinforcement that this potentially could be a high probability trade. If we think of an exit, From an uptrend, it's when it goes into sideways trend or reverses and goes into a downwards trend. If something's in a downwards trend, it either goes into a sideways trend and we exit, or it reverses and goes into an upwards trend, in which case we exit. So it's still price action orientated. And if it's price action orientated and the indicators are based on price action, then why shouldn't you start to look at exits using MACD signal lines or parabolic SARs or prices crossing MAs or MAs crossing? Why shouldn't you look at those things as a potential exit? So tools for half a job or using the tools for half the time? The other thing, of course, is again, I'm going to blame us educators for it because we have education and strategies related to discipline. But when we talk about discipline, it's often discipline in entry execution. Just do a YouTube search on entry versus exit, the psychology of entry, the psychology of exit. And what you'll find time and time again is there are a number of videos that are there for entry is almost infinite. It just goes on and on and on and on. Whereas a number of videos associated with exit, particularly the psychology of exit, very few and far between. And even less so if you want some degree of quality that goes beyond matchbook psychology. So you need to seek it out. You need to seek out actively exit education, not just scroll through and, oh, that looks interesting. That one. You need to seek it out. Ask the questions. Poke your educator in the ribs and say, hey, give us some stuff on exits. Do the research, do the work, do the learning, test out the systems, measure what's happening. Develop unambiguous, specific statements that guide your every exit trading action. And if you want to use some trading tools which may indicate a move is over rather than a move has just begun, doesn't that sound like a great thing to invest some time in? Anyway, there's your 6. So to summarize, let's reiterate the key points. Entry arousal bias, as I've termed it, is normal and is contributed to not by the way the trading community is, but the way we're taught. You've got to battle through that. You're in control. You have it in your power to change that. Not only start to rebalance the effort and energy you invest in your exit knowledge and confidence, but also the power to start now. Not think, oh, yeah, that's something I'll have a look at in a month. Make this a video you take some action on. Whether you like it or don't like it, whether you subscribe or don't subscribe, whether you write comments or don't, that's up to you. As far as I'm concerned, I do these videos to try and make a difference. And if there's one thing I've said in this video that you can resonate with, and it's enough to make you take action, or enough to help you to take action, then I've done my job. The first stage is awareness and ownership. You need to own where you are now as a trader. Recognize the gaps and do some things that are going to make it different, that are going to make it better, that are going to help you fulfill your potential. And of course, let us know if we can help. I'll put my email in the description at the bottom. You're very welcome to email me personally if you want to know of any resources I can point you in the direction of. So remember, follow through to make a difference. Consider the 6 influences on your entry arousal bias. Ask yourself the question, how many and by how much these may resonate with you now. Look back at recent trades, make a judgment in how well you managed exit. Make notes what you're seeing when you have this relook back. And make some judgments on where the gaps may be for you right now. Is it a mind shift that's needed? Is it some more learning that's needed? Is it tightening up one particular aspect of your exit strategy that's needed? Do you need to look at trail stops in a bit more detail? Do you need to look at take profits in a bit more detail? Only you can make that decision. And the best place to start to look at decisions you need to make is trades that you've already taken. Commit to following through, take some action on any areas you need to rebalance. Your trading future is something that you create by taking action. Utilize the power you have to make that happen. It's really that simple. I'll see you again in another video. Thank you once again for giving it any attention at all. It's always a pleasure and a privilege. Trade safe and see you again soon. Bye bye for now.